Hi, Jim Gore from THOR Wealth Management. When I started in the business in the mid-'80s, it was very easy to get income for clients. 10-year treasuries were yielding over 10%, and the stock market was yielding over 6%. So having a 50-50 portfolio, you were getting 8% yield. That's not the case today. Let's look at what is going on in the yields, especially the real yields. This is looking at the real yield of 10-year treasuries. So what this is the yield minus the inflation rate. So it's negative. You're not making enough money right now on a 1.6% yield on a 10-year treasury when inflation is more than 3%. So the last time we saw something like this was back in the early 70s, where we saw real yields dropped as we had inflation. Well, look what happened in this chart over in the late 70s and the 80s. The real yield was really good. I remember clients back when I started in 1986. Boy, we're getting 10, 15% yield on some of these treasuries that we bought back in 1980. Yes, and you did very, very well. You made real yield. That was fantastic for you at that time. But notice here that the real yield, the average since 1960, the real yield on 10-year treasuries is 3%. What that means is, assume that the inflation rate is 3%, it's probably higher than that. That means that you should be getting 6% yield on 10-year treasuries right now, not the 1.6%. So the Federal Reserve is very, very lax right now, and they're causing inflation, which could be a disruptor, especially if we get into a situation like the 70s, which we think we might do with stagflation. Now, that's the fixed income market, but you also have to look at the equity market. The equity market here, once again, the real yield is negative. Last time the real yield was negative was back in the early 80s, and then 1970s again. The first time it happened was the same time it happened for the fixed income market. And what happened was the yields really went up significantly, and you had good yield. Why? Because the prices dropped. And people have to be concerned in this market. So where does someone go for yield right now? Where do you go as an investor to have some money so you're generating some income? Well, this is a chart that we showed a month ago when we were talking about MLPs. And you can see here that the MLP yield is paying you more than inflation rate, and you're getting a real yield on that investment. The other areas that you're getting a yield that's probably close to the inflation rate is in high yield bonds. Now, one has to be very careful there. Those things are good to get that income, but if the economy slows down, high yield bonds are susceptible to getting hit pretty hard. And the reason for that is because these are highly indebted companies that if they cannot pay off their debt because things slow down, you as an investor could get less money than par value on those bonds. So, this is a time that someone has to be very, very careful. You have to look at in your portfolio not only income, but taking some capital gains as well in order to provide that income. This is not like the 80s. It was a lot easier back then than it is today. And you have to be a little bit more dynamic in order to get that income to you if you're trying to get 3-4% out of your portfolio. We understand that here at THOR. We're doing things in our clients' portfolios in order to protect against inflation. And this is a time that really investors have to be very, very careful in both the bond and the equity market, especially here in the United States. Take care, and we'll talk to you again in a couple weeks.